All right, I want to welcome everyone to today's webinar. I'm Ryan Fisher with CamaPlan. I can be reached at 215-283-2868 or rfisher@camaplan.com. We have a very special guest with us today, Paul Moore. Paul's going to teach us some successful tax strategies that the super wealthy use. I'm sure everyone will enjoy what Paul has to say. However, I just want to let everyone know the CamaPlan does not endorse or give any investment advice. Everything presented today is for educational purposes. I just want to let you know there is also a chat box. You're welcome to ask any questions in the chat box, and Paul or I will answer as many that we can here for you today. So welcome, Paul.
Hey, it's great to be here. Thanks, Ryan.
And I'm switching this over to you. So
All right, we'll see what
great to have
happens.
you, Paul. Good to see you again.
Hey, it is great to be here as well. Thanks to you, thanks to Carl, thanks to the audience. How you doing with my screen there?
You're good. You're up and running.
All right, fantastic. So, should we roll?
Yeah, absolutely. Let's get right
All
into
right.
it.
So, Ryan, I was puzzled over the years. I like to consider myself a serial entrepreneur, and that's actually something I'm not super proud of right now because serial entrepreneurs are constantly in startup mode. They're constantly trying the next thing. They're constantly, learning and growing and booting up. And over the years, I made a lot of money as an entrepreneur, and I lost a lot of money as an entrepreneur. In fact, I've got a podcast called How to Lose Money, where I interview successful entrepreneurs, investors, managers, executives about how they lost money on their road to success. But what I noticed along the way is that a lot of the super wealthy folks in the US, a lot of the Forbes 400, invest in commercial real estate. In fact, a lot of them made their money through commercial real estate, and others maintained and grow their money and grow their assets and perpetuate their fortunes through commercial real estate. And I'll tell you, one of the reasons is the tax advantages are crazy. I talked to a friend of mine who was a multifamily syndicator and a long-term investor in commercial real estate in California, and he said, if the American people knew how much money we pay in taxes, he should have said how little money we as commercial real estate investors and syndicators pay in taxes, then we'd have another tax revolt on our hands, because there are so many tax advantages to commercial real estate investing. I think maybe only oil and gas, which is far, far riskier, has more tax advantages. So we're going to talk about those today. Now, disclaimer, you already made a disclaimer, but I'm going to make another disclaimer. I'm not a CPA, I'm not a tax accountant, and I don't even play one on TV. So that's an old joke for you who are on the call who are over 50. There was a very funny, at the time, commercial from the 70s, but we'll leave it with that. So I have been on here before, like you mentioned. I'm Paul Moore. I'm an author of a couple real estate books. I'm working on a couple more books. One is going to be called Warren Buffett's Rules for Real Estate Investors, and another one I'm hoping to write a book. I'm working on a book on self-storage as well, in addition to the multifamily book that I have right now and the other one that I wrote quite a few years ago. I am the director of Wellings Capital, and we have a couple funds for self-storage, multifamily, and mobile home park investing. So, but like you said, today we're going to talk about the top 10 tax strategies for commercial real estate investors. If you're still paying taxes on your investments, this is a great place to be. So, strategy number one, hire a tax strategist. Now, a guy named Ed that I got to know, we were actually building a Hyatt hotel in North Dakota after doing a successful multifamily project there in 2011. And we were also building a Hyatt hotel. My friend was actually building the hotel. I had a broker's license, and I found a piece of land for him. I helped him connect with Hyatt and got him going. He built what I believe is the nicest Hyatt House hotel in America, to my knowledge at least. and I was helping him out, and we started thinking, I wonder if we're really maximizing our taxes. Now, if you're an investor, a syndicator, an operator, you should probably be asking yourself that question too. Are you really maximizing the structure of your business to minimize your taxes? That's what I should have said, not maximizing your taxes. And I did a Google search for a tax strategist, which is something I'd never heard of. And I found this guy named Ed in California. Now, Ed was paying about $120,000 a year as a real estate syndicator, operator, investor. And one day he stumbled across a couple of tax saving strategies that he didn't know. And he went to a CPA, I believe they had lunch together, and he said, hey, what about this strategy, which is one of the strategies we're going to talk about today? And what about that strategy? And the CPA said, yeah, those are great ideas. You should probably do that. And he said, wait, you knew about this and you didn't tell me before? And after he badgered the guy a little bit, the CPA said, look, you pay me to do your taxes, not to be your tax strategist. Ed got mad and he fired the guy, as you can imagine, and he hired a CPA that was more proactive and that could teach him how to save money and structure his his companies and to minimize on taxes. And so by hiring a tax strategist, Ed said that he saved $120,000 a year in taxes. You might recall that that's what he was paying. He said that in the decade since then, he has paid about zero in income and capital gains taxes. It's because he learned to use the laws to legally structure his portfolio in a way to minimize his taxes. So there are accountants and there are tax strategists. You may want to work with an accountant. You may want to not fire your CPA. There's no reason you have to, but you want to make sure you get a strategist involved to make sure that you're structuring everything in the best way possible. So who do you contact to do that? If you want to get hold of me at Wellings Capital, I can tell you a couple people that I recommend as tax strategists. You may be able to find your own. Again, the point is not that you fire your CPA, although you might want to do that. The point is that you want to find somebody who really cares about you and who will help you proactively structure your business. So tax strategy number 2 is invest directly. Now you can invest in a company that buys and operates real estate, and that's not a terrible thing to do. But if you are investing directly in the real estate itself, you're not going to get a 1099, you're going to get a K1. And if you get a K1, you're going to basically be a direct investor in the real estate. And direct versus indirect means that you actually are a fractional or partial owner of that real estate, and you are going to be able to get a piece of the depreciation and all the tax savings that come along with having a K1 as opposed to getting a 1099. So if you're getting a K1 from your real estate investments, which most of you probably are already, then you are in the right place. If you're getting a 1099, then you may want to wonder if there is a better way to go. Tax strategy number 3 is the strategy that I think Ed used to meet when he met with his CPA that day that put him over the edge to fire that guy. So it's accelerated depreciation through cost segregation. Now this is a pretty hot topic right now. If you look at the depreciation on a normal commercial building, it's 39-year straight line, which means you can take the cost of the building, not the land, and the improvements to the building, and you can depreciate those equally over 39 years. So if you paid, I'm going to do math on the spot here, it's probably a bad idea, Ryan, but if you paid $3.9 million for a property, then you could break that, divide that by 39, which I believe would be $100,000 per year, and you can take that off your taxes through depreciation. So if you make $100,000 a year profit, you have $100,000 a year write-off, you're going to be break even on your taxes. So it's a great way to reduce your taxes, but a better way is to accelerate that depreciation, because you all know, you're smart IRA investors with CamaPlan, you know that increasing your write-offs and decreasing your stated income in earlier years dramatically, and I mean dramatically, increases your wealth creation over many years. And so accelerating your depreciation looks like this. If you have a 39-year building, or 27 and a half if it's multifamily because it's considered residential, if you can take certain items like the roof, you can depreciate that over 15 years. The electrical outlets, the windows, the lighting, the carpet, the other fixtures, the plumbing, the parking lot stripes, the shrubbery, the pavement, all kinds of things, doors, windows, etc., can be depreciated over a much shorter time. And because these are pieces of the building versus the land, they can be depreciated, but they can be depreciated on a shorter time schedule. And so if you can depreciate some of the items I mentioned over, say, 5 years, some 7, some 15, you can increase the depreciation in the earlier years. And if you do that, you can often find that where you would have been getting an income, a positive number on your K1, you're often going to be able to get a negative number, sometimes for 5 years, sometimes for even longer on your K1, and that is a benefit. This really comes down to what is real versus personal property. If it's real property, like the walls of the building itself, and if it's something that's not going to go anywhere, then it's probably going to be on the longer time depreciation. But if it's personal property, and again, they consider that things like lights, windows, cabinets, countertops, faucets, these are things that can often be depreciated more quickly. And so there are two kinds of cost segregation studies. They're called the engineered study, and another is a basic study. An engineered study might cost you something like $8,000, $10,000, $12,000 or more. And then a basic study can be as little as, say, $1,000 to maybe $4,000. And these basic studies are a little bit simpler, a little bit more basic, but both of those are valid. And the IRS does demand that you have a third-party study. Typically a CPA and an engineer is involved in this. How much can you save? Well, Ed found that he was able to, through this method and a couple others, take his positive $120,000 a year he was paying to the federal government and to the state of California and turn that into a negative number. There's no telling exactly how much you'll save, but it's very, very likely significant. Now, if you're investing as a passive investor with an operator, one of your emails to them or calls to them today when you're done with this webinar should be, are you using a cost segregation study? And if you're not, why not? And there may be a few reasons, few cases out there where it doesn't make sense, but often it does. Like I mentioned, these cost anywhere from the low $1,000 to $4,000 range for a simple study up to maybe $10,000 or $15,000, $10,000 or $12,000, I should say, for a higher cost engineered study. Who qualifies? Well, generally the investors or owners of any commercial property. If you're at like $200,000, $300,000, $400,000 or above, you may want to consider the higher cost engineering study. If you're at say $100,000 commercial property, let's say a rental home even, a residential rental home or a duplex, you may want to consider the simpler, lower cost study. Tax strategy number 4. Correctly classify deductible expenses. You're probably aware that a lot of accountants out there, they just, again, this is getting back to the accountant versus the strategist, they will just classify the expenses, and sometimes they will just classify expenses and put them in a bucket that is depreciated over 15 years, or heaven forbid, 27 and a half or 39 years. Some of those expenses could actually be classified as expenses that could be repairs and could be deducted in that year. In 1992, I started my first business. It seems like a long time ago, Ryan. And I learned that we were able to actually deduct up to $15,000 in the current year. In other words, we could take that HP printer and we could take that computer and we could take the fax machine and we could write it off all over 1 year. We didn't have to drag it out over 5, 7, or 15 years. Well, now the
Great.
limits are much, much higher. And I believe they're $1 million now. And so we're looking for deductible repairs versus capitalized improvements here. Are you familiar with Section 179 of the IRS code? If you're not, you should be, because this has been expanded recently. We're going to talk about that later on the webinar. So again, make sure your CPA and your accountants are correctly classifying deductible expenses. Let's talk about tax strategy number 5, and this is return of principal. Now, this may not seem like a tax strategy, but I think it is, because if you can get your principal back out of an investment, first of all, it's basically like refinancing your home. If you're looking for money, let's say you have a $500,000 house west of Philadelphia and you have that house paid off and you're really looking for some money to invest, you've got some great investment opportunities, you may choose to refinance your home. Let's say you refinance $300,000, 60% on the home, and you invest that, and let's say you're paying interest of 4.5% on the home, on the mortgage, but you can get an investment that pays you double that, let's say 9% or even more. Well, you may choose to do that. Now think about the proceeds from that. The proceeds from that would be tax-free. Or if you invested in something and they refinanced, or if they were able to get you back your principal, that principal would come back to you tax-free. It's not income. Therefore, there's no impact on your taxes, but you've got the money back in your hands and you can actually reinvest that. So an example of this is in our Wellings Income Fund. We actually, our intent is to refinance the principal back to our investors in years 4, 5, and 6. And by refinancing that back to the investors, they're able to take that money and reinvest that. And effectively, that means one seed that was planted becomes 2 trees that grow. And this is an opportunity. This principal return is a tax-free way to get people's money back to them and get that reworking or churning like banks do.
Absolutely.
Tax strategy number 6 is actually just about the same. It's refinancing, tax-free, and reinvesting. And so we actually talked about refinancing your home. An example of that is, again, it's very simple. It's very similar to the return of principal in the last one. Refinancing is a specific way of returning principal to our investors. Tax strategy number 7, people are familiar with tax-deferred exchanges, and that would be like a 1031 like kind exchange. And we're going to talk more about that toward the end. But the way it works is, originally when people would, let's say someone was selling their peach farm to buy a tomato farm. Well, if they had to sell their farm for $100,000 and they had to take a big tax hit, and if you're in California, that's a really big tax hit on capital gains. It's not only the federal, but state tax. I was actually talking to an organic farmer out in California. He was in Fresno. I was there 2 weeks ago. And he said that he was going to be paying something like 45% of his $2.25 million proceeds from selling his organic farm. But if he could do a 1031 exchange, he would be able to exchange that farm for another piece of real estate. It doesn't have to be a farm for a farm. It can be a piece of real estate for another piece of real estate. Now, this gentleman was really concerned. He said, boy, it'd be nice to actually enjoy the proceeds from this. And I said, well, you may want to look into this. And again, I'm not a tax professional, but I have one client, Ryan, that actually sold a whole bunch of apartments and he bought a vacation home at a place that he wanted to eventually retire. Well, he rents that vacation home out now, and he's doing that for a couple of years. But he said at the end of 2 or 3 years, he is going to actually move into that home and convert it to his primary residence. And guess what? All that capital gains that accrued over the years that he thought he was going to have to pay is actually going to be wiped away according to him and according to his 1031 exchange guide. Again, I'm not a professional. It's kind of hard to believe for me that the IRS allows that, but I did check with a 1031 exchange guy recently who said that many, many people do this and they seem to do it successfully. There's also a 721 exchange. Example of a 721 exchange is, I'm just going to put this in real simple terms. If you build up a business, and let's say you build it from the ground up to a $100 million business and you sold it to Warren Buffett, you may say, gosh, I hate to pay the capital gains on that 100 million. What you could do is you could exchange the shares of your company for shares of Berkshire Hathaway. And by doing that exchange, that is also tax deferred. You don't have to pay on the capital gains. You don't have to pay money at that time. You are deferring that for a future time period. And that $100 million, you can actually enjoy that by converting that to $100 million of Berkshire Hathaway stock. Well, in the same way, that can be done with real estate. If someone invests in a real estate fund, and let's say that fund has a 10-year life and it's shutting down at the end, if those assets are going to be retained and continue to be operated by the operator, then that operator might want to put that into a new fund and then give you the opportunity to do a 721 exchange into that new fund. Tax strategy number 8, avoid passive loss limitations as a qualified real estate professional. There are passive loss limitations, and I believe, again, everybody should check their own tax situation, but in many cases, the passive loss limitations are $25,000 per year as a passive investor. But if you're a qualified real estate professional, in other words, you do real estate as a profession at least half time, then you are able to write off much more, sometimes an unlimited amount. So if you have a huge loss in a given year, you can apply it all to that year on your tax return. A qualified real estate professional is defined as somebody who works at least 750 hours per year in real estate of any kind, and at least half of all their working hours on real estate. And so that's 2 of the 5 or 6 ways you qualify. The others are a little simpler than that. But if you want to check into that, you can Google this. You can Google how to become a qualified real estate professional. If you're semi-retired or retired, this can be a great way to go. Sometimes people have their spouse qualify. I know of an investor in California whose spouse, whose wife is actually a real estate broker, and she's very involved with their investments. So it's pretty easy to see that she is putting at least 750 hours a year and well over half of her time in real estate. And so they're able to qualify that way. Tax strategy number 9. It's our favorite, Ryan. Maximize self-directed IRA and 401k investments. Now, if you're here with CamaPlan, you know that this is a great option to defer or to actually invest tax-free. Who should do this? Well, I think everybody should do this. I really do believe that everybody should have a self-directed IRA and everybody should be investing that. And I'm not just saying that because I'm on a CamaPlan sponsored webinar. I say this everywhere. If people don't know that they have these options to do self-directed IRAs, they really need to. But I need to put a disclaimer in, Ryan. Sorry. I think there are a few people who should, I don't know if they should avoid it or if they should be really, really careful. But here's what I mean. There are people out there who I call shiny object chasers. These are people who are all excited about the next fad, and at every turn, they're ready to dump all their, or a huge percentage of their retirement income into the next big thing. And I know people who have done this. I know people who have lost their retirement income. I think a lot of those people would be better off if they had a self-directed IRA to just have accountability from a spouse, a brother, a friend, a coworker to say, no, I'm going to put around myself a little board and I'm not going to run after this next big thing. I'm not going to jump into the next oil well that promises 100x return. That might happen, but it might not. And if I'm going to invest, I'm going to invest only a certain amount. I really think this is important. And Ryan, I think if this, maybe you'd even want to jump in here and tell us, do you think this is a big deal with self-directed IRA investing?
I do, and I'm a big believer in diversification. Like you said, I don't think, you should dump all your eggs into any one basket.
Mhm.
Um, you have the ability to diversify this using a self-directed IRA, and I think you should take advantage of that, because you never know what's going to happen and things change and, predictions, vary.
Right, absolutely. So I've had a few people over the years, Ryan, who've said, I don't know if I want to use an IRA. I'm worried about the UBIT tax. And so I got tired of hearing this question. So I went to a CPA and I said, hey, look at our opportunities here. Look at the operations, look at the investments we're offering our people. Can you tell me how the UBIT tax might affect somebody in these situations? And he went through and he said, well, it shouldn't affect them that much. I mean, we're talking, these K1s with this accelerated depreciation, the return of principal, the potential for a tax deferred exchange. I mean, there's all these tax saving devices you have for everybody. Well, those those negative numbers on the K1 year after year in the early years of an investment, it's basically going to minimize the UBIT tax and make it almost a non-issue. And this guy, who's a super smart tax planning CPA, he's a tax strategist, he said it was very, very minimal. Any comment on that, Ryan?
Yeah, and it really depends. A lot of the times it depends on how things are structured. I don't, you get mixed articles out there. Some are kind of shedding bad light and saying UBIT is bad, but I don't really think it is. And it only depends on certain situations. But like you're saying, there's ways to minimize that, but there's also ways that deals can be structured to, avoid that. A simple example, right? If somebody's flipping properties instead of the IRA, buying the property and flipping it, it might just want to be a lender and collect part of the
Mhm.
profit and let John Doe or ABC LLC go flip the properties and just be a lender on it. And, then the investment is fine and it doesn't, UBIT wouldn't apply. So you just want to take the situation and say, what's the best way to do this?
Right. So, Ryan, could you take a minute to discuss limitations on contributions and any other limitations on an IRA that people might want to know?
Yeah, Roth and traditional IRAs, if you're under 50 years old, you can put 6,000 in. They give you an extra 1,000 if you're over 50. There are other ways to get more money in, and you'll want to talk to your, CPA or tax professionals. You have simple IRAs, SEP IRAs. The SEP you can put up to 56,000 into that. Then you can also do the solo 401k, which also gives you higher contributions as well. And you can have um, multiple accounts. You only want to have one employer plan between like the SEP, the simple, and the 401k, whichever one fits your situation best. But I think everybody should definitely have a Roth IRA. I'm a big believer in, tax-free income for life. So, and it doesn't matter. Anybody can have that no matter what you make. If you make too much to contribute, you can always put it in a traditional and convert. And we have
Right.
plenty of people that do that each year.
Okay, great. Thanks for sharing that. So,
Absolutely.
um, tax strategy number 9, again, maximize your self-directed IRA and self-directed 401k contributions. Tax strategy number 10. Ryan, I don't know if you're old enough to remember this, but when I was a kid growing up, my mom always said there's 2 things you can't avoid in life. Do you remember what they are?
Taxes and death.
Right. Everybody's going to die and everybody's going to pay taxes. Well, you might only have to do one of those. It's possible to reset the basis at the end of the line because there are some people who tax plan, and it's not that hard to avoid all the capital gains tax that they accrued all their life and that they continue to kick the can down the road through a series of 721 or 1031 exchanges. It's possible that they actually are able to avoid those entirely, and here's how. If you cash, let's say you're 99 years old and you really feel like you're not going to live that much longer, and you decide to cash in all your investments, pay all the capital gains tax, and divvy up the cash between your heirs. Well, that's okay, but you may have a massive capital gains tax that's built up over decades. Another way to do that would be to allow yourself to go ahead, this sounds terrible, allow yourself to go ahead and pass away, and then allow your heirs to sell those properties. Now, if you do that, it's often the case that capital gains, that the basis in those properties is reset when they're inherited. So if you've got, let's say, $1 million basis in $20 million of property, then you would have capital gains tax of 19 million if you sold before you passed away. But if you let it pass on and it was $20 million in total value, then the basis could be reset. Now, there are limits on this, but that basis, if it's reset to the new value at the time you pass away, it's possible that depending on the amount and depending on if there's a spouse involved, etc., it may be reset to a place where there is zero capital gains. The limits on this just doubled. I don't have those right off the top of my head, but I believe it just went from $5.5 million to $11 million. But I think it can even be better than that if there's a spouse involved. Again, it's not something I have off the top of my head, but speaking of new limits, let's talk briefly about the Tax Reform Act of 2017 and the benefits to real estate investors. You know, love him or hate him, we've got a real estate investor sitting in the Oval Office. And that real estate investor, I think, got together with his friends in Washington and really helped us real estate investors out with the Tax Reform Act that was passed in December of 2017. Did you know, Ryan, that in November of 2017, about 50% of people polled in a national real estate investor survey said that multifamily had peaked and it was probably going to be softening. But in February of 2018, right after the Tax Reform Act was passed, about 72% of people said, no, it's not peaked. It's got room to run. And of course, here we are a year and 5 months later, and it really has, and it's continued to run up, which basically says that's one piece of evidence, at least, that the Tax Reform Act really did have a positive effect for real estate investors. I just looked at the clock and realized we're almost out of time, so I'm going to hit these real quick. You probably know about the 20% pass-through deduction. Who's this for? This is for people who have an active involvement in the real estate investment. So you can't just automatically get this as a passive example, but as a passive investor. If you have $100,000 in income and you're being taxed on that, if you qualify for this, that $100,000 in income might be now deemed $80,000 rather than $100,000, and you'll be taxed at that lower level if this applies to you. You don't have to have an LLC to invest in to do this. You can be, there are all kinds of structures that tax professionals now tell us will work for this pass-through deduction. Number 2 bonus is bonus depreciation. I talked about Section 179 of the IRS code. Imagine you've got an apartment complex with, let's say, 100, 200 units, and you have to replace the roofs on all those, and that's $1 million. Well, guess what? Instead of depreciating that $1 million over 15 years, from what I understand, with Section 179 bonus depreciation for a limited time, that's up through, I believe, 2023, you're able to deduct the entire $1 million in the same year and then carry any residual losses forward. It's a great deal. Tax reform bonus number 3 is the fact that we got to keep the 1031 tax deferred exchange. Did you know if you're an art collector, if you buy and sell cars, airplanes, even patents, there were 1031 exchange opportunities for you in the past. But under the new Tax Reform Act, those were all eliminated, but they were kept for real estate investors. I wonder why. Now, the 1031 exchange is a great benefit to people who can take advantage of this. And we are really, really glad that they kept it in place for 1031 exchange investors. Now, I didn't advertise this, but I'm going to talk very briefly about avoiding a 1031 exchange, but still getting the capital gains tax deferrals. So the first way to do that is through one of the tax reform benefits, and that's investing in an opportunity zone. Now, an opportunity zone is an area designated by the state government saying that they would like to see this area gentrified. And we've all heard stories in the paper about these really nice areas that somehow ended up in an opportunity zone. I wonder how that happened. I don't know. But basically, there are limits to this, and there are all kinds of conditions, but you might want to check into investing in an opportunity zone. You can actually defer taxes that capital gains that you would have made on stocks and other real estate investments by investing in an opportunity zone. A lot of those benefits are going to be realized if you can pull this off within 2019, because the benefits start to drop as you get out in time. They really want to get this done quickly, and it's working out well. We already talked about a 721 exchange, and that's an exchange, a stock swap. I talked about selling your company to Berkshire Hathaway. And I also mentioned that, I think I mentioned that Wellings Capital is planning to do this in our income fund for people who want to hang on at the end of 10 years. Tax avoidance strategy number 3 is called an installment sale. I just met with a gentleman in Irvine, California a couple weeks ago who explained this to me. Basically, it is a way to sell your property. The IRS approved, or at least put the language in the IRS code for this way back in 1913. And this allows you to sell your property with an intermediary involved, and it allows you to get approximately 93 to 95% of the money from that sale immediately. And then you set aside a little bit of money that grows over 30 years, and you pay your capital gains at the end of 30 years. So a quick example of this, if you sold a property for $1 million, let's say you're the seller and you're selling to a buyer, what you do is you put an intermediary in the middle, you sell it for $1 million to the intermediary, they sell it to the ultimate buyer for $1 million, they have no gain, so they don't have to pay a capital gains, but then the deal they structure with you when you sell it to the intermediary is it's an installment sale. So it's sold over with payments due over 30 years. And they structure the payments in a really clever way that allows you to get, like I said, typically 93 to 95% of all that $1 million. In other words, about 930 to 950,000 of that million at closing. What a great deal for you. And then you don't have to pay all that nasty capital gains tax for 30 more years. And if you're older, you may be able to take a life insurance policy out to actually pay that capital gains tax at the end of the 30 years. So that's another opportunity. If you want more information on that, I don't have any more, but I can pass you on to a tax strategist or two that I really like that knows a lot about this. So Ryan, I think we're to the part of the webinar where we can take some questions. So if you have any questions coming in, if you would like to ask me, that would be great. I'll let you sift through those and I'll try to look at them myself.
Paul, how many 1031 exchanges have you done?
I have done none, actually. Great question. I have not been in a position, and I think I should have. We actually flipped a lot of waterfront lots in the early 2000s, from 2004 to 2008 at Smith Mountain Lake in Virginia. And if I would have been smart, I would have been scheduling those closings to do 1031 exchanges. I actually was using a self-directed IRA though, and so I was able to actually avoid taxes anyway by using the
Right.
self-directed IRA, but I haven't done a 1031 myself. I've had clients who have.
Yeah, absolutely. And I'm familiar, and I think it's a great tool that people should use. And they do need to look at that, and there's timing to locate the properties and
Right.
swap that out. But I definitely think people, if they're in the position to use that to their advantage, is great. So
I will say briefly that people, a significant percentage of those fail because people don't have the property identified in 45 days or
mhm.
they don't close in 6 months. So I'd highly recommend that people get the property identified before you go close yours.
Yeah, absolutely. And that's why it's important to, work with a CPA or professional that's familiar with this and get those ducks all in a row before, because that word gets thrown out a lot. Oh, somebody knows, they did a 1031, but there's a lot of details involved in doing that.
Right.
But I think we're out of time here today, but let me ask you, do you have a slide to put up your contact information, and how do people find your podcast? Because I think it's great to learn from your own mistakes, but it's better to learn from others, what my dad
I
always said to me.
I agree. I love it. That's good. I need that. It's great to learn from your own mistakes. It's better to learn from others. That's great. You can ignore all this information on this page, but you can go here to schedule a call with me, or you can email me, paul@wellingscapital.com. You can also email us at info@wellingscapital.com, and we can schedule a call to review questions or review anything that's on your mind.
Absolutely. Well, I appreciate you taking the time. This is great information. I can also be reached at info@camaplan.com, or personally at rfisher, that's with a C, RFISCHER, at camaplan.com.
All right. Thanks, Ryan.
Thanks, Paul. Have a great day. Thanks for
You too.
attending, everyone. If you need any information, we're welcome to help you in any way we can.
Thanks.
Welcome.